to be wealthy? Do you want to be in control of your finances? Do you feel like you mostly get financial advice from people who are trying to sell you a bank's products? If your answer is yes to any of these questions, then stay tuned because you are at the right place. Welcome to Money Convos, a club committed to helping people achieve financial freedom by providing education and guidance on personal finance and investments. We have a group of experts who share their knowledge and give practical advice with no strings attached. At Money Convos, we have candid, mature conversations about wealth, how to create it, grow it, and protect it. We share our experience and encourage our audience to share theirs and ask questions. Join us every Thursday on Clubhouse at 7 p.m. GMT. We also have book discussions that bring out practical lessons. So far, we have read Dumb Things Smart People Do With Their Money, The Richest Man in Babylon, and The Millionaire Next Door. Most importantly, we have one-on-one financial coaching sessions where we guide individuals through setting financial goals, retirement planning, budgeting, investments, risk management, and so many more areas. The goal is to get you to financial independence from whatever income level you're at. Follow us on Twitter, Instagram, YouTube, Facebook, and Clubhouse. The handle is at moneyconvosgh, or send us an email at moneyconvosgh@gmail.com so we get you started on your journey to financial freedom. Now that you're all caught up, let's head into our next conversation.
Hi Jenny, how you doing?
Hello, Elike. I'm doing well, thank you. And you?
I'm great. Yeah. So, how was your weekend?
It was good. It was
I
good.
like the
Yours?
sound of that. It was. It was a bit. I wanted it to be relaxed, but I wasn't relaxed. So, there's that.
It wasn't.
Okay. All right, but hey, I'm taking a few days off work this week, so more.
Yeah.
Hopefully, I'll get to do some relaxation today. I didn't succeed at that, but hey, tomorrow is another day, so why not? Anyway, so all too soon we have come to the end of this book. Isn't it just interesting
Yeah.
how the year is just going? Every week we do a money convo session, we do something, and
Yeah.
as week goes
Yeah.
by,
Before you
then
realize. Yeah.
the year is over. Hey, Charlie, it's not easy.
Yeah.
Anyway, so we are having our final session of the Intelligent Investor. This is a book highly recommended by Warren Buffett. So we'll take the last 5 chapters, 16 to 20, and then we'll just do a quick wrap up of what we've gathered so far in this book. To anyone who has found this interesting, feel free to drop some comments in the comment section or hit us up on social media to discuss this book. Okay, great. So without much ado, let's get into it. Chapter 16, and it was a chapter that quite in keeping with what we've come to get used to about this
Yeah.
book. Things getting a bit too technical, right? We based in Ghana, we wouldn't appreciate convertible bonds. There's not
No.
something
Yeah.
not something that a lot of institutions have. Let's see, which Esla doesn't have it. No, Esla is not a convertible bond. Yeah, it's a quasi government, right? We a lot of people wouldn't be able to relate to it, but I think there were some lessons in there. There were some lessons in there that I picked. Um, how about you? Were you totally lost when you were reading this part, or there were some lessons you also picked?
So it was quite interesting because the only time I've had any experience with convertible bonds is when I'm learning about them in a textbook sort of thing. So it was really nice to have a, let's say, a discussion on how practical it could be when you are found in a situation like that. So yeah, it
Mhm.
was quite interesting to
Oh,
read.
okay, that's great. That's great. Then let me talk about what I found interesting, and it was quite in keeping with the themes of conversations me and you have been having on the professional side. We work together
Yeah.
in DataBank's private wealth unit, and it was about something like drink deep or taste not.
Yeah, from the Prairie Spring.
Thank you, thank you, thank you. Right, and this is the idea. Convertible bonds seem to give you that sense of. Okay, wait. Let me start with convertible bond. What's our convertible bond? So a normal bond, a normal bond is giving a loan to an institution, a company, and what you do with this loan is that you give them a certain amount, and then they should be paying you interest either semi-annually or annually, depending on how you agreed upon it. And on maturity dates, they'll give you back all your money plus the last interest payment. So it can last for 5 years, 10 years, 20 years. It's a loan, it's a bond. But with convertible bonds, the twist to it is, there are shares where you are giving a loan to a business as a bond, but there are shares where you can be a shareholder in the business. But with this one, you will get it's a bond, you're giving a loan, lower risk. They are supposed to pay you if the business is going down. You are
You
ranked
have first
higher.
claim. Mm.
Thank you. You have first claim, so you can get your money earlier than shareholders. But with this one, there's the option for you to convert. Maybe you think, okay, this company, let me give them a loan for now. Maybe in some years to come, when they have good prospects, I'll buy it at a cheaper price because you would have agreed on the price ahead of time. So that's what the convertible bonds give you, that option to convert part or all of what you hold in the bond to become a proper shareholder, a full shareholder of the business. Now that's on the structure. Now this part, what the book is talking about is how it sounds like a good deal, right? It's fixed income. You're getting, people who take lower risk get lower returns. So
Return. Yeah.
you will be getting something stable. At least they are paying your interest. They are paying your interest over time, so small, small, small. But there's opportunity that when things are going well, when things are going very well, you can just cross over and then you end up
In the
as a
business.
shareholder so that you get upside, right? But here's the thing, because you have that extra option, someone with a convertible bond will get lower return than someone with a normal bond. So you thought you were getting a good deal, but on the interest rate side, you get lower interest. Now on the pricing side of the to convert, you may not get that good a deal. So that's where the book says that it is the best of it. You think so some people think that they are getting the best of both worlds, but actually you end up with the worst of both worlds. So you're not getting even the full equity upside that you were hoping to get, right? I know I may be speaking at the top, above the top of your heads, or perhaps I've confused you, but I'll just specify the lesson I learned. What do you as an investor want to achieve? You want a hybrid, you want a certain blend. Use the best method to get that blend. If you want diversification, or if you want to lower your risk, the way to do it is diversification. If it's bond you want to buy, buy bonds. If it's shares you want to buy, buy shares. And if you want to diversify, don't buy just one, buy multiple of them. Don't put all your eggs in one basket. Don't buy just Coca-Cola. Don't buy just Apple. Don't buy just Amazon stocks. Don't buy just GCB stocks. Diversify across, because there are certain things that if you do and you don't do it right, you may end up increasing your
Your risk.
increasing your risk, but not also increasing your return,
Return.
right? And just the last thing I'll say is more directly on the conversations we were having on dividends. Some people like certain stocks because they will pay dividends, but the stock portion of your portfolio is where you want to chase return. You are doing, let's say, 80% in fixed income. That 20%, you want it to double, triple, so that you can get higher returns. But the fixed income part, the 80% is playing safe. It will just get you steady, steady returns. Hopefully, you don't lose your money. Now, if the part that is supposed to chase risk, you also make it behave like a stock, like a fixed income,
Fixed income.
you won't even get sufficient return because companies don't pay a lot of dividends. Just
Yeah.
3% in Ghana, average 4.5 to 5%. Compared to, whereas you just go ahead and do stocks that you think can get you higher returns. I'm not saying these returns are guaranteed, but there's the opportunity. Fan Milk did what 300% plus. That means your money would have tripled in 1 year. Um, Total did almost 100%. Bob also did 200%. You know, there are different stocks. They have the opportunity to get higher returns. So my whole point is, if you want to do something, know what you want to do and go with the best tool to achieve what you want to do. You get what I'm saying? Don't
Yeah.
go and play a different game. Don't mix and match and achieve the wrong results. Basically, is what I'm saying in a long-winded form. Jenny, what do you think about this?
So I just want to read something from the book, two things
Hmm.
from the book, and then I will say something. So it says, although convertible bonds are called bonds, they behave like stocks, work like
Exactly.
options, and are cloaked in obscurity. And I'll come back after I read one last thing. I'll come back and then talk about this. You can best shield yourself against loss, not by buying one of those quirky contraptions, but by intelligently diversifying your entire portfolio across cash, bonds, and the US and foreign stocks. See, we if you own convertible bonds, you have this mentality that, oh, I can time the market,
Hmm.
that I can I can really be strategic such that, let's say, I'll buy the dip or I'll buy very low when I think that the price of the security has really gone down. So when I convert, even convertible bonds, you convert at a predetermined price. So you can't say you are buying high or low. But let's say you think that this is a good time to convert your investment from, as Elikem said, fixed payments to very erratic payments that may are not even guaranteed. And you do that and you realize that the company isn't as um are not going to be paying you dividends like you thought, or they're not even getting capital appreciation, which is the difference between the price you bought it for and the price you're selling it for, like the way you thought it would be. And then you've giving up your very sort of quote unquote guaranteed returns for something that you is very uncertain. So it's it can go haywire. It can really go haywire. And if it's not for your in your plan that, oh, I'm going to buy equity or I'm going to buy fixed income, you should really stick to one part of it, because even in professional investors get it wrong sometimes. Let alone somebody that you think that um you don't have the knowledge in the industry like that, but with your, I'm sorry to say limited, but then with your quote unquote limited knowledge, you think you can, let's say, time the company or the market to be able to do that. It may go horribly wrong. And so you should just stick by, as a normal enterprising investor, stick by the normal traditional ones that we have. If you want some bonds, buy shares. When you start playing with contraptions like convertible bonds, then it becomes very dicey for you, because you may time the markets very wrong and you won't get the returns that you thought you'd get. Yeah, thank you.
Thank you so much, Jenny. I like the angle you brought on timing the market, because effectively it is about you timing, thinking that you can outsmart the market and convert it at the right time. Good point there. Thank you so much. Okay, so let's move on to chapter 17. Now, this is an interesting story. This is an interesting story in the just at the beginning of the commentary. Jenny, would you like to read it for us?
Yes, please hold on. So, is it the one with the wisdom god? Okay, sorry, I
Yes.
was yes, okay, I was looking at the book. The wisdom god Woden went out to the king of the trolls, got him in an arm lock, and demanded to know of him how order might triumph over chaos. Give me your left eye, said the troll, and I'll tell you. Without hesitation, Wooden gave up his left eye. Now tell me, the troll said, the secret is watch with both eyes. Now
It's
he
too
has three
late.
eyes to
Yeah.
apologize.
Yeah. You gave up your eye and now you have only one eye. How do you look carefully? How do you use the secrets that you just learned? Amazing. Thank you so much, Jenny. That was an interesting way to start that chapter or the commentary on that chapter. And for this chapter, it is really about Being aware, understanding, look with both eyes. That means be careful. Be careful before you leap. So I'll take a few points. But Jenny, are you there? Seems like there's a bit of connection
I
there.
am here. Can you hear
Okay,
me?
yes, your picture is frozen.
Oh, okay.
So you can turn off the camera and turn it on again, and let's see if that would unfreeze it.
Okay. Am I back?
Still frozen. But anyway, we'll take it like that. I'm sure it'll work out. Okay,
Okay.
great. So with this chapter, what the author did was he compared some companies, or yes, he gave us certain companies to look at. And in these companies, we learned a few lessons. For one of them, it's a it's a bad purchase, right? And they were having relaxed credit policies just so that they can push product. In fact, in Ghana, there's been a recent example. I think it's Unilever on the Ghana Stock Exchange, where they were pushing products and now they have a lot of receivables on their accounts. Now, if you are listening to this and it sounds outrageous or it sounds over the top of your heads, you don't know what I mean. In Ghanaian language, let's say wako free. Someone has gone to buy goods on sale on credit and the person hasn't paid it back. So if you are the seller and so many people owe you, well, you don't have the cash. You may say you've made profits because you sold it, but where's the cash to back the profit up, right? That's one of the things. And it comes back to this quote showing on screen where it says, look with both eyes. There are certain things that the management would want you to be looking at. There are certain financials or lines in the financial statement that they may want you to be looking at while hiding what they actually want you to, what they don't want you to see. So you need to look with both eyes. And if this sounds a bit daunting, then that may make you wonder, especially if you're a Ghanaian where our investment industry hasn't gotten so sophisticated that the average person can look at financial statements and understand. Perhaps you should leave managing the stocks to a professional to do it. Someone like Jennifer or me who wakes up and then that's all we are doing, trying to figure out where is the right investment to go. There's no plug, but it's really about knowing what exactly you're getting yourself into. And sometimes you have to admit, maybe you're biting off more than you can chew. If it's even a normal business that you are doing, a friend's business, try to understand what's going on. What did you say you sell? How do you collect your money? Just basically keep an eye out. Make sure you understand everything that's going on. I think a previous chapter, Jenny, it talked about how when you're reading financial statements or annual reports, start reading
Start
from
from
the
the
back.
back. Yeah.
That's a good one. But yeah, so I think that's what this chapter really is about. Keeping a close eye, and it can easily things can easily escape you, but you need to keep your eyes open. Any other thoughts on this chapter?
Yeah, so there are a plethora, yes, there are a plethora of ways that accountants can use to like be able to get things around you. So you really need to open the two eyes, and so there's a myth that human beings have a third eye here. Yes. So if you can open your third eye, open that one too and look, because there are lots of ways that people can use to cook numbers for you. And I think one of the companies in the book that they spoke about was so it's TYK. I don't know if it's Tyco or Tico, but anyway. So that company was growing through mergers, which meant that they weren't actually producing, like they weren't manufacturing anything. Can you hear me?
Yes, I can hear you. Just checking something on my camera. Yeah.
Yes, please. So they weren't going through production. They were going through mergers and acquisitions. So they'll just buy a company, write a lot of, let's say they'll have a lot of goodwill, and then they'll be amortizing it and all of that. And you realize that, oh, it's like this company is growing, oh, but they weren't profitable. So if you are just looking at their asset or something very limited, you would say that, oh, Tyco is a very good company, when they weren't actually producing anything, and strictly based on their business, they weren't a going concern. So you need to be able to like check out and not say that, oh, you trust everybody. Look at it from the angle of I'm going to see if there are discrepancies, because if you're just looking at it like, oh, human beings, business as usual, it's possible that you won't really critique anything. But if you look at it as, these people are going to do something, so let me see if I can catch them in the act, I think it will give you more of a way to, yeah, be more vigilant. Thank you.
True. Great example there with Tycho. It's and sometimes it's not. So there are companies that would do things that just trying to outsmart people just to make investors or make people make their earnings look better, because the managers, is the better the company looks, the more they will get paid. So it's in their interest to do that. But you as an investor, you know, you need to keep an eye out for some of these things. It may look like they, they will have a good justification for it. They will explain some things, and if you are not well versed in that field, you'll be dribbled. So you just need to make sure that you understand everything. And sometimes, if you're not comfortable with it, you just walk away. Right? For our first book review for Money Convos, the book "Damn Things Smart People Do." First lesson in there: if you don't understand an investment, you don't
Don't
do
do it.
it. Exactly. I was just talking to a friend this weekend. I know it's a bit different, but we were talking about some investments she has. She wanted to make sure she was in the right investments. And then I asked her, okay, you have two investments from one company. What's the difference between the two? Oh, my friend was doing the second one, so I thought I should also do it. And I'm like, hold up. You know what? I'm not going to say it's good or bad, but first, get me all the information you can get me about that thing, all the flyers, all the brochures. Get it to me. Let me understand it and let me explain it to you. If you understand it, you continue. If you don't understand it, you get out. Simple like that. So it's like that. Sometimes you may not understand certain things, but try to get people to explain it to you. If it's becoming too much work, Charlie, you never know. Just probably save yourself the drama, right? Don't lose your money. Okay. All right, then. So that was chapter 17. Let's go on to chapter 18. Now, this is an interesting blurb, but I wouldn't highlight too much on the blurb or the intro there, old English. But basically, talking about there's nothing new under the sun. I love that saying. There's nothing new under the sun. And you think about it, let me digress a little, right? We are talking lately, we've been talking a lot about NFTs. Jenny, do you understand NFTs?
I don't think so. Please, what's the full name?
Non-fungible tokens. So related to blockchain, people selling digital art.
Cryptocurrencies. Okay,
Yes.
okay. Please explain it.
Okay. All right. So in a nutshell, I hope I don't mess this up. But hey, if I mess it up, pardon me. It's all new to all of us, right? But so there's digital art, or there are items. Non-fungible tokens are such that now you create something that you can put on the blockchain, and there's a unique item. You know how you can Google the Mona Lisa and you can see the images easily. But the real Mona Lisa is sitting in
Yeah.
the Louvre Museum in Paris. They are the
Yes.
only ones who can see they own it. But hey, you can get to see it, right? Now, the non-fungible tokens make items very unique and they can be verifiable, so that you know that this particular item is for this particular person. And people can copy it, they can do whatever they want with it, but you
The
own the
original
rights
one
to
you
it.
don't. Yeah. Okay.
Exactly. So now people are selling them, and some people are selling them, and it keeps getting higher and higher and higher. And in a way, because of the technology sitting on the blockchain technology, where cryptocurrencies are based on the blockchain technology, it seems new and buzzworthy. But after a while, as you start getting to understand NFTs and all, you realize that, hold up, wait a minute, it sounds new and all, but isn't it the same art market that people have been selling Picasso's and Rembrandts all this time? Art markets, people sell bottles of wine, people sell, just at this time it's digital.
Yeah.
That's the difference. It's new, but
It's
really it's
not.
based on our old.
Yeah.
Exactly. It's new, but it's not new, right? So yeah, just a digression. Sometimes people may come at you saying something is, oh my god, this is so new, this is so new. Just today, I was also listening to a podcast on WeWork, how they crashed and whatnot. And they were saying they're a tech company, but really they are a real estate company. They're like Regis and the other companies like that. But they were saying they were a tech company, and a whole lot of exuberant stuff, hyping up the stock, the company, and like they're doing something so amazing. But really, co-working spaces, real estate, it is what it is. Anyway, so long story short, there was a bubble, it got hyped up, and eventually it comes crashing out. Now they had to get back and refigure things out. They were growing too fast for their liking or for their own good. How is this similar to what this chapter is saying? Be careful, right? Understand the company and understand the price. Understand why um, the price is moving in a certain way. And we've mentioned many times how Jeff Bezos said Amazon is the company
Not
is different from
right.
the stock price.
Yeah.
Exactly. The company is not the stock price. Separate these two items. And for those who love cars, I use this example. It's there are different types of cars, but I think a lot of us can agree that a Toyota Corolla is a good car, especially for a young person starting out life. It's a good car. Question is, right now, you go to the market, it's 80,000 thereabout, depending on which year model, or maybe even 60,000, depending on which year model you are going for. It's a good car. But if I say that buy this car at 200,000 CDs, would you buy it? That's a question you need to ask. Would you buy it? So perhaps you may want to ask yourself, the car is good, but the price is not good. It's like you go to the market. So those of you go to the market, you are going to buy tomatoes. Jenny, or can you tell me any foodstuffs
Oh, we have
that you know
carrots. Now
the
I'm
price?
going high tech. We're doing keto diet. So yeah, we have carrots, we have beetroots and all of that.
Great. And how much do carrots cost these days?
Now three is 5 CDs.
Three for 5 CDs. Great. So
Yeah.
you go to another shop where they are selling three for 20 CDs. You pause. Yeah, carrots are good. They are going to help Jenny with her keto diet, you know. So that one is not disputed. But the price I'm buying it at, the price you are buying it at, is it good or not? That's the question, right? And yeah, that's the question you need to ask. So you need to make sure that people are hyping up things. They are saying, "Oh, revenues are growing astronomically." How much further can it grow to drive the price up? These are some of the underlying things that you need to ask. But the bottom line is, what price are you paying for it? Yeah, Jenny, any thoughts on this chapter?
So I want to read the last part of the what you have on the screen. It
Okay.
says, "See, this is new. It has already been." Okay, is there anything whereof it may be said, "See, this is new. It had already be of it had been already of old time, which was before us." There's nothing under the sun. I want to give an example with this is a very low scope example, so please pardon me
Mm-hmm.
if it looks like I'm broadcasting my naivety. Um, so when cryptocurrencies came first, Bitcoin, one of the things that they were saying was that, oh, you see the way fiat money, they just print anytime to dilute and everything, and then it's not based on anything of real value, because you see at first the dollar was based on gold, and then
Mm-hmm.
now we took out that gold, and then its value was its money, like the money printed, the amount printed on it. So then they were saying that, oh, the government can just dilute the currency and all of that. But then you see crypto came and
Mm-hmm.
people mine, so they are diluting it as well. Like crypto is also not based on anything of value. The value is based on what the people put on it. It's so then it doesn't have an underlying value, just the same as fiat currency. People mine it, so it's almost as if the central banks are printing money there. So it has a lot of similarities, which means that it may be built on something, so it's not entirely new. It has a basis on something. So um there are very little things new. Okay, we can be technology is coming to show us that, oh, there may be new things on this earth. Very soon we'll be able to look on in our palms and do things. So yeah, but then when it comes to investments, it is rinse and repeat. Most of the time, rinse and repeat. Then we tack on one thing and then we make it new. So look at the price of the whatever it is that you're going to buy. As Edikem said, make sure that it is you are not only looking at the technical analysis to say that the price was here, it is going here, it is doing this, doing that. and then so I'm not going to look at what is underlying, and I'm going to just buy it on it. Usually when people are just, a lot of people are doing that, and then they sort of pump the price of the security. You see that they'll have to dump it one day, and then you are found holding something that people just pumped and dumped, and it doesn't really have value, because at the end of the day, the whole business is such that if um yeah, what happens? I'm trying to look for a diplomatic way of saying it. If the company goes bankrupt and then they're liquidating the underlying assets, they'll be able to share it for all of us to get it. But if you're not really looking at the underlying assets, and you're just looking at the price at which people bought it for and then people sold it for, if something happens, we'll all be caught holding papers, and they'll be of no value. So yeah, thank you.
Yeah, yeah, yeah. Very true, Jenny. Very true. Especially in these times when we are just coming from a year where the Ghana Stock Exchange did was it 43% in or was it 46% or so in
20, yeah.
2021? So people are looking at Fan Milk, Bob. Oh, wow, they've done 300%, and you want to get in. Chairman, are you sure? I'm not saying don't get in. Well, I'm saying, are you sure? Do you have enough information to make you know that this is a good decision? You have to check. You have to do your homework. You have to do your homework, else other people eat your lunch. And just the last point I'll make on this chapter is more like reading something in there. I've heard Warren Buffett say it, but it seems it's actually he got it from this book. And it says, as Graham liked to say, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. In the long run, it is a weighing machine. Voting is a popularity contest. It's a beauty contest. It's not really about who can do the work or not. It's just who do you like at the moment? Who do you like? Quite often in my experience, I know bringing back sad memories from when I used to stand for elections and didn't win. By the way, people care more about who is popular, who is nice to them. Meanwhile, they don't focus so much on who can get the work done. And in Ghanaian society, actually, a person who can get the work done, they'll say he's too strict, he's too straight. Granted, you should merge all these things, but what should you be focusing on, right? It's about the long term. It's about the real worth of the company. It's about the weight of the company. That's what you need to focus on. And over the long term, it will show. And the book gives many examples of companies that were popular. People like them. They were buzzworthy. This is the next hot thing, and in no time came crashing down. So you really need to give that some thought. And it's not just about the stock prices going down for these ones. It's actually about them going bankrupt, a lot of these companies. So you need to read this book, especially the commentary. If the main text is too hard for you,
Yeah.
yeah, read the commentary. All right, so moving on to chapter 19. It's talking about shareholders and dividends. Charlie, it's like this dividend wahala that I got into
Yeah, we are
at
getting it
work.
into everywhere.
Yeah, I can't run away from it. Dividends. Just to put this out there, look, I think if you are buying shares, you go for capital gains. But when I was reading the book, I got this context, and we discussed it. In the US, in developed markets, you'd be glad to get 2% on a fixed income instrument. It's you'd be very lucky to get that, right? But in Ghana, you don't take risk. You buy government treasuries, and you are
Nice.
getting 20%. 19, 18, 19, 20 easily. Put your money there, go and sleep. They will print the money if push comes to shove for you.
And pay
Or
you. Yeah.
yeah, or they'll tax us, add more levies and stuff, to get raise the money to give it to you, right? So in our context, dividends, you get what, 3, 5, 6% at
Yeah.
best. Why bother? Go in for the capital gains, potential to get 30%, 60%, 80%, 100%. Yes, you may lose everything, but the upside is infinity, right? Anyway, so
Yeah.
that's my take on dividends. Oh, and just to be clear, dividends is when the company says we made some profit. Here is the instead of reinvesting it in the business, we'd rather just pay some to shareholders so that they can also chop some of the money, returning some money to the business. Jenny, any thoughts on this chapter?
Okay, so when I was reading it, I really like the way they put it, especially the commentary. Different investors have different reasons for investing. Old people usually invest for dividends, because they need that sort of income that will come every, let's say, semi-annual or annually for their needs. Young people like Elikem, aggressive investors, do not, they prefer capital gains to dividends. So yeah, I like the way he said that the company's board of directors have a duty to
Mhm.
report to the independent outside shareholders, outside people that are not in the company. So report to them about your dividend policy. If the company is making enough returns for the people, about your dividend policy, and about, let's say, share repurchase and any other like share like buybacks and things, report to them and let them know that this is what I am going to do, so that if they don't want to stick with you for the, let's say, your dividend policy or something, then they have the option to go and look for somebody else who has something else that they can have. Yes, so I think it is really good. Like, we can, let's say, some companies, you see MTN has a very good dividend payout policy. And I know that when I was in sales in Sunyane, old people were saying that, oh, at least if they pay them krana, they can know that they have some shares that at every year they can be getting like 2 pesos on a share or something. Yes, so Elikem doesn't like dividend, but then those people really love dividend. So let Elikem go where he likes, where it is we are reinvesting the money's profits back into the company, and then we are aggressively growing the company. And let the old people to go for companies where they're going to pay dividend, and we will all be happy. Yeah, thank you.
Yeah. Great, great, great. And but Jenny, I would encourage you. Add the caveats in like, yeah, you may be old, you may want dividends, but actually, what you want is not dividend. What you want is income.
Just, yes, you want guaranteed
You
source
want
sort of,
income.
yeah, yeah,
Good. So you need to go for the investments that will give you the income.
income,
In
yeah,
Ghana, you can do fixed income, but in the US, in developed markets, the fixed income wouldn't give you so much
private
return. So
group, yeah.
yeah, yeah. All right, great. And another point besides the dividend, which you also raised, was about the duty of directors to shareholders, the duty of managers to shareholders. It's the chapter talks about how, as shareholders, so far it's like we've been talking about how to select the good investments to buy. How do you know what is good to buy? But another thing is, as you've bought it, as you are holding it now, you're a shareholder, you're an owner. Doesn't mean you should just go and sleep. No, you should monitor it. There are certain things you need to check. As a shareholder, you have a right to make certain decisions, to vote, to hire and fire managers and the board. So yeah, people say that, oh, by your shares, you just own a few shares. It's not much in the grand scheme of things. But guess what? They all add up. They all add up. And in fact, there are even laws that help protect interests of minority shareholders. So that it's not just majority carry the vote. So the majority shareholders will just be doing things to
Just
harm the minority. So you just have to get involved. If we've been talking about, be careful about what the company is doing, what is in the annual report and all those things. If they are making decisions or they are writing things, they are showing financial statements that you don't agree with, what should you do? If it's that bad, you sell. But before that, explore the option. You take a vote that you don't like something. Just because the manager said, "Oh, let's vote for this," doesn't mean you should agree. You have to have your own idea of what you want. And if you don't agree with it, you vamoose. You try to change it, or you get out
get out.
of the company, right? By selling it. So you need to know when to sell to. That's a good point that the book mentions. Okay, great. So we can take the final chapter and then we look at some general lessons we've picked from the book. So moving on to chapter 20. If we fail to anticipate the unforeseen or expect the unexpected in a universe of infinite possibilities, we may find ourselves at the mercy of anyone or anything that cannot be programmed, categorized, or easily referenced, said by Agent Fox Mulder of the X Files. I love this part, risk. Risk. As Jenny alluded, I like risk. Yes, I like taking reasonable risks. Granted, it depends on what I need. If I my general investments, because I have short-term investment, short-term needs for money, not a huge chunk of my money is invested in the long term, but I have cryptocurrencies, I have equities, some equity mutual funds and all that, because I understand risk, right? So to each person, you must understand risk for yourself. Jenny, for you, what is risk, or how do you define risk? Not by the textbook, but how do you understand risk for yourself?
So for myself, risk is when um my money is going very very differently from what I thought it was going to happen. So for instance, where volatility today is up, tomorrow you go and look at it and it is down, and then the next day it is here, it is there. Yes, I don't like volatility, so that is risk for me. Yes.
Great, great. And guess what? Both of us are investment professionals, right? We've read the same textbooks, right? But guess what? We are two different people. And this is my definition of risk. My definition of risk is you have to risk it to get a biscuit. My definition of risk is, as all things being equal, if these people, one, are these whoever I'm putting my money, are they doing what they said they will do? Yes. And when they do what they said they will do, is there potential for me to get better returns than the
Returns
normal
from there.
person, you know? And I usually compare with just giving the money to the government in a treasury bill. If they follow those things, okay, good. I understand this. I may lose all my money. I put in 100 CDs, I may walk away with nothing, right? Or I also understand that I may put in 100 CDs and I may walk away with 1,000 CDs.
Lots of,
That's
yeah.
yeah. I've multiplied. I've gotten a factor of 10 of my money times 10 of my money. I may also walk away with 1,000,000 CDs. I put in just 100, but walk away with 1,000,000. That's the potential, but it's not certain. Nothing is guaranteed, and I understand that. All right. So for the part that I want to take risk, no problem. If I lose it, I lose it. Just that I don't put all my money into these kind of investments. I just put a small portion that I don't mind losing in that kind of investment. That's how I understand risk, right? So with this in mind, we need and perhaps I should also clarify. One risk that I won't accept is the risk of fraud, the risk of corruption, the risk of people stealing. That is a risk that I wouldn't accept. Like someone is coming to steal my money. No, mine is confined to people doing what they are supposed to do. And pardon my French, things just happen. It is what it is. You had no control over it. So yeah, that's me on risk, right? This book is talking about something about risk. Besides encouraging people to define risk for themselves, it's saying don't lose money. Jenny, how did you understand that part? Don't lose money.
So don't lose money. I like it in the context of what we are reading, because I seem to identify it as don't intentionally lose money, because we are talking about where anything can happen. Like anything can happen outside of your control that can make you lose money. But don't, let's say, overpay for something that you could have underpaid for, just because you're so enthusiastic about the company or something, that you went in blindly and went to do something. So don't cause money to be lost by your own actions, sort of. Yeah. Yeah.
Amazing. I like how you put it. In fact, I didn't think about it in that term. And that keyword you've put there, intentionally.
Yeah.
Intentionally. That means you actually had a chance to make a good decision, but you didn't. It's one thing to look at a company and take the finance sector crisis 2018, 2019 that happened. Yeah, people put their trust in certain financial institutions, and the financial institutions went down. Some of these institutions, they went down because, or they lost their licenses because the managers made bad investments. Some of the banks, they were just giving loans out to their directors, major shareholders, and they weren't paying back at good, very low interest rates, but they just weren't paying back. So of course, depositors' money is lost. Now, this is where the intention comes in. If you, as an investor, you want to invest in such a bank, you know that this is what they are doing, and you put your money in there, that's intentional, right? Now,
Yeah.
it seems so blatant, as we've said it. Oh, but such a thing there will be very obvious. You shouldn't do such a thing. Okay. What if an institution told you that give them money and they guarantee that they'll give you 10% return every year, or even maybe more every month, 10% every month, effectively 120% every month. Then you ask,
Every
what
year.
business do they do? What business do they do? And they say they buy and sell gold. And you try and understand it, but you realize that no. To be honest, if you do your homework, you realize that no, the way the gold prices move, they can't guarantee that 10%.
Yeah.
But you go and put all your money in there, it's on you. You had the chance to do your homework. You didn't do your homework. You didn't call some friends who are into the finance sector to make them help you understand it. You just didn't put in enough checks and balances. You were, pardon me, but you were greedy. You just wanted return, 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 return. Well, guess what? Your money will burn. Your money will burn. So thank you for that. Intentional is the key word. And intention is, you had an opportunity to do some research on it. You saw the red flags, but you still went in there. That's on you, right? So don't do that kind of thing. Don't lose your money. Another way I also saw it in terms of don't lose money is, it's not just about each individual investment. This book, we've been talking a lot about diversification. And with diversification, when one investment goes down, another at least
You
can
go
help
up.
cushion it.
Yeah.
Some go up, some come down, and even if they are not going up, they are all down. They are all flat at the same
Flattening.
level. And you lose all of one. At least if you lose 10%, you still have 90% to hold to your chest, right? Go with the diversification. And with diversification, you may lose one or two, but that's fine. But it's when you make deliberate decisions and you lose, or maybe you don't diversify well enough. You just buy two companies and you say, oh, one will do well, one will not do well. You lose a huge chunk of your money. The book says losing some money is an inevitable part of investing, and there's nothing you can do to prevent it. I love this. There's nothing you can do to prevent it. You will lose money at a point in time. But to be an intelligent investor, you must take responsibility for ensuring that you never lose most or all of your money. I have a friend like that from some years, and some years ago he had a good job. He was earning comfortable. He was earning not comfortable, a lot of money. He was throwing a lot of money away, spending on frivolous things. And it hits hard times. And in fact, while he was still earning the money, I encouraged him, you come and invest in my company. We don't have outrageous returns, but we try to do conservative investments that you keep your money safe. He saw the returns and he was like, nah, scratch that. I'll go to men's gold. And he went to men's gold. I thought he had lost what 30,000. When later on, as we're having conversations, he sent way more, way more. But you know what? Can you even complain about all you lost? Because you had been getting 10% a month all this time. You didn't use even what you were getting well. You were just blowing it because, oh, more will come, more will come. So that's, you doubled your money in a year, but actually on paper you just kept the same principal and you chop all the returns. You just chop everything. It's gone, and now you have nothing to show for it, right? Don't put yourself in a situation where you can lose most of your money or all of your money. Just don't do that. That's, I really appreciate it, and I like how this is how the book ends. After all is said and done, your decisions need to put you in a position where you don't lose all your money. But there's one last thing that I'll say, but I'll give you a chance. Any more that you want to say on this chapter about this before I hit the last point?
So there was a part that he said that whatever, I think we've had this conversation to when he came. He said that
Mhm.
whatever you don't be too confident, like be overconfident, because whatever you are, if you are selling, somebody has some information that they want to buy. So is it that the person knows more than you do, or you know more than the person does? Because you are at two opposite ends of a transaction. You are probably thinking that the company isn't going to get so much more for you now, and so there's a time to leave. The person is thinking that, oh, I'm going to get so much upside from this company that it is the time to buy more. Yeah, so you don't get overconfident in your ability and then say that, oh, because of, let's say, my superior knowledge or something, I'm going to put all my eggs in this basket, as Elikem said. But know that there may be things like nuances, very small, small nuances that may even go beyond your understanding or perception, which can really impact the value of a company or something, or what investors perceive it to be. And you don't get overconfident and put all your, like, go and put all your money somewhere or your eggs somewhere, but then you still spread it, because as you are spreading, you are diversifying the risk of um one company collapsing your everything, so that even if you are wrong in one company, it doesn't take, it takes, let's say, a part of your money out and not the whole basket. Yeah, thank you.
Great, 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 great. That's a good example. It just got me thinking as you were talking about, as some the people say the prices are going down. Guess what? As you are selling, someone is buying.
Nobody's buying. Yeah.
So yeah, good points there. The last thing I'll say, which I think which the book refers to, is the risk is not in our stocks, but in ourselves. Early in the book, it was said, the psychology of money, it was said, and I'll repeat it. The greatest risk that comes when it comes to that comes in terms of investing is ourselves. It's I see it so often, biases, and especially, Jenny, the conversations we've been having recently, people trying to play safe. You have a plan, you are following the plan, but for some reason, there's this nagging thought at the back of your mind. Maybe not, you're not too sure. You have a plan, you chose a good plan, right?
Yeah.
Okay, stick to it. Now, there's a saying, only a fool says he won't change his mind. I agree with that. So, revisit it once a year or whenever. Revisit it. Is the plan still viable? Yes, it is. Continue. Don't allow yourself to be pressured. Don't allow yourself to be desperate to want to get out. And having an emergency fund helps this, right? Again, this friend I was talking to this weekend, when I took it, when she made it sound like, oh, she's not investing enough, she's struggling. But after we did the breakdown, when you take just her salary, can you imagine she saves about 67% of her salary, or she invests it, and she's still feeling some way, but
Inadequate.
inadequate. But granted, we got to realize that she has a lot of side gigs that are bringing a lot of money. She doesn't put it all in, so the percentage will come down to maybe 20%, but that's still good. That's still better than
Yeah,
nothing, right?
yeah, yeah.
But here's the key thing: she had an account meant for long-term investing, and she recently just went to empty it because she got into hard times, because she overspent. But that's the thing, you've opened so many accounts, you don't have a plan, and you just went to clear a major account.
The
But
long
if
term, yeah.
And I was telling her about have an emergency fund. In fact, this what triggered that conversation is I said, "Oh, you should have an emergency fund so that you don't do such a thing. Have like 3 months to 6 months money expenses
Salary.
saved up in this account." It's like, "Hey, where am I going to get that money from? How can I just put 3 months?" And I was like, "Wait, hold on. Let's look at your budgets." Then we actually saw how much she spends, and I was like, "You can actually do it. In fact, you have a savings habit, so you're not even someone who can complain to me about this." But that's the thing. Her mind is, where will I get to put 3 months expenses somewhere? Blah blah blah. But It's all in her mind. It's all in her mind. So
Yeah.
at every point I'm talking to her, I'm like, write it down. Don't worry, don't worry. You write this thing down. Let's look at it objectively, black and white. And you realize that I can help. So I encourage everyone, and in fact, this will be more my the general thing I've taken from this book.
Yeah.
You are your greatest risk. So try to be more objective. Try to look at some things with cold hard facts. Understand everything. Don't let people bamboozle you. Make sure you understand everything. And most importantly, diversify. Diversify. Jenny, how about you? Concluding thoughts?
So the you are your worst enemy is so true, because most of the time people don't even talk us out of like investing. We now will talk ourselves out of it. Hey, now this thing that I said I was going to buy, let me wait small, and my money is not enough. 100 cedis, how can I be investing 100 cedis? Then if I wait when it's 300 and when you invest, before you realize the time is gone, nothing has been invested. And so like you really need to make sure that you keep yourself in check. Like, if anybody can talk you out of anything, it's you. So I think you really need to keep yourself in check and make sure that you are not sabotaging yourself and your investments. Yes. And I think another thing, if I didn't take anything else from this
Mm-hmm.
book, it is diversified. I think it was in every chapter for aggressive investors, for enterprising investors, for defensive investors. No matter who you say, like what type of investor you say you are, your best bet is to diversify. And I remember when we're talking about the enterprising investor, and when we're saying that no matter, let's say if you say that, oh, you dear, you can pick stocks, you can pick securities and everything, make it 10% of your portfolio, which is going to say that the other 90% should be across other investments that are fully diversified, so that you are just playing with your 10% and you're not really sabotaging the growth of your whole portfolio. So diversify. Let your be, diversify across companies, across industries, so that no matter where the economy is going, if the whole economy is going down, even if the economy is going down, there's some companies that do well, because no matter what we eat, like we'll come and talk and talk and talk and talk, but we'll still eat. Yes. So there are some things that you know that as you are diversifying, when the whole economy is going down, they will be coming up and we'll still be able to balance your portfolio. So yeah, thank you.
Great. Thank you so much, Jenny. Diversify, diversify, diversify. Okay. So, all too soon, we've come to the end of this book, a book highly recommended by Warren Buffett. Next book we are taking starting next week is Who Moved My Cheese? And next week we will be joined by David. David is a member of the Money Convos team.
Happen
He's
no.
Papa no, he's our big brother. So I'm looking forward to having him here. He's so crazy about this book. So it will be good to hear his perspectives on this book. So look forward to that. Who Moved My Cheese? We'll be reading it over the next 4 weeks. So get the book. If you have any challenges getting the book, just message us on anywhere on social media, Instagram, Facebook, Twitter. It's at Money Convos GH. You can see the handle down there on the screen at Money Convos GH, or send us an email at moneyconvosgh@gmail.com, and we will reply on how we can get you the book. All right. So, also don't forget to hit us up on Clubhouse. Join us in our conversations. Those ones are more interactive. 7 p.m. GMT on Clubhouse. Do join us and let's share some thoughts over there. All right then. Thank you so much, Jenny, for your time as always joining us here.
You're welcome too.
And thank you for all those in the audience. Mimi, I see you in there. Do enjoy your week. I wish you all the best. Make some money so that we can all invest and grow it. Bye bye.
Bye. Thank you for taking the time to listen to our thoughts. I hope you learned a thing or two and start practicing. Don't forget to follow us on Twitter, Instagram, Clubhouse, and Facebook, and subscribe to our YouTube and podcast. Do tell a friend about Money Convos so we all become wealthy together. Talk to you soon. Bye.